Nvidia is currently trading at $789 a share. Since the start of 2024, it is up 64%. This is one of the craziest stocks in the stock market right now. They've just had their earnings. We're going to be going through those numbers and seeing why the stock had a 20% increase in that time. What we're going to be doing is going to my automated stock valuation spreadsheet to see if Nvidia is a buy or a sell using discounted free cash flow model, the comparable company model, and finally the Ben Graham formula for intrinsic value to see if Nvidia is a buy or a sell. So let's get straight into this. Well, as you all probably know, they have recorded record revenue, 22 billion. Data center revenue is up. Full year on revenue is up 126% to 60 billion. The news from the earnings has gone pretty well for Nvidia. So let's have a look at this stock. As you can see, up 63% in that time. If we go in the last 5 years, if we go to the pandemic, bottom of the pandemic, it was a $51 stock. It is up almost 1,500% since then. It's absolutely crazy. This is a stock that constantly proves people wrong, constantly proved me wrong as well. I said it was overvalued at around $330 a share, was feeling pretty good about myself when it went down, and then since then it is up almost 600%. So this is a stock that has proved people consistently wrong. So what we're going to do is have a look at my automated stock valuation spreadsheet. If I just type in Nvidia in here, this will load up all the company's latest financials, and we will be able to see if it is a buy or a sell. So yep, as we can see here, Nvidia, let me just make this full screen, sorry. Tools, view, full screen. Look at that, what a difference that made. Yep, so Nvidia, it is $790 a share, has a market cap of 2 billion. That is one thing I just want to touch upon here. It is currently, 2 billion, 2 trillion. It is the third biggest stock in the S&P 500 based on market cap. Only Microsoft and Apple are bigger. It's bigger than Amazon, it's bigger than Meta, bigger than Google, bigger than Berkshire. It's bigger than everyone I could name apart from Apple and Microsoft. It's the third biggest stock in there, which is absolutely crazy. Also, check my Patreon in the description. This is where I'll be going through my automated stock valuation spreadsheet. So we'll have a look at some of the values here. P ratio is 66. Now, this is the one thing about Nvidia that people don't like. Current P ratio of the market is around about 27.5. 66, you basically have to go back to the dot-com bubble when things were about that high. Oh, sorry, that's 2008. And then back to the dot-com bubble as well. So that is one of the things that people do not like about the stock, is its very high PE ratio. Earnings per share, about $12 a share. Beta 1.7. This means it moves a lot more volatile than the market. Market obviously being 1. Shares outstanding 2.5 billion. Target price $832. Analysts are expecting it to go up. They do pay a dividend 0.02, which is 16 cents a share. Around about 400 million in dividend. Is it safe? Yes, it is very safe. A small fraction of what they have in terms of payout ratio and free cash flow payout ratio. So let's get into the revenue numbers. We'll look at the bigger chart here. This is the revenue going back to 2011. Ignore the trailing 12 months because this is an updated chart. So it's the most recent earnings of 2024, end of the previous quarter. And revenue is up 60 billion, all-time high, blowing out all their previous revenue estimates, previous reported revenues, 26 billion, and up to 60. So that is what we want to see. We want to see massive revenue growth. Next, we're looking at the profit. Is the profit telling a similar story? Yes, it is. 29 billion in profit compared to 4 and 9 in the prior years. So once again, that is what we like to see. Shares outstanding. What are Nvidia doing with their shares? I believe this was due to a stock split here, due to the numbers here, but you can see they are gradually buying back their shares, but pretty much it's been flat the entire time. Some issuing, some buybacks, not really a big thing. This is a way they could reward shareholders by buying back their shares, but currently they are not. Obviously, the stock price shouldn't matter, $800 a share, but a lot of people can be turned off by that being too high, and then if they did a stock split, did a 4-to-1 stock split, it will bring the price down by 4, and look at that, it's already up another $3 since I've started this video. But then people who are scared of buying fractional shares, some people don't buy because they think it's too expensive to invest, but really you just buy fractional shares. But this could bring other investors in who are a little bit timid of buying this. Assets versus liabilities. You want to see assets greater than liabilities, and yes, it has been pretty close over the prior years, but then this has jumped up massively, so that is good to see. And finally, free cash flow. Why do we care about free cash flow? Well, they can use it to invest in the business, purchase properties, upgrade, and then also pay dividends as well if they want to. And free cash flow is up massively, 27 billion compared to the prior years. You can see this massive growth again. Now let's have a look at my discounted free cash flow model. This is a way of valuing companies using its future free cash flows. I'm going to say that discounted free cash flow will not like Nvidia. And yes, if we look at averages, they currently have the stock price at $121 a share. So let's have a look at some of these numbers here. In terms of revenue growth, pretty all over the place. 55% was in the previous year. So let's go on the really bullish side. Let's say they do 55% every year for the next few years, which I would say is very unlikely, but you never know. See, that still brings it up to a $300 stock. Net income margins are very high, up almost to 48%. 48%. So let's add that number in here. And then free cash flow rate, we'll go on the high side again, 90%. So this is assuming that it could do everything that it did last year. It would still be overvalued. It would be a $600 stock. And I don't think this could happen. This is massive growth. It would basically be doubling every couple of years. I don't think this would happen, but discounted free cash flow does not say Nvidia isn't buy. What we'll do now is we have a look at the comparable companies model. What this is a way of valuing companies using metrics of similar businesses. Things we're looking at is EBITDA, which is earnings before interest, taxes, depreciation and amortization, EV to revenue, EV to EBITDA, and PE ratio. So what I'll do is just on another screen here, I will look at Nvidia's companies that are similar. Obviously, one that immediately jumps out is AMD to me. So let's AMD, ticker AMD. We'll see what other ones they provide. Intel, of course, INTC. And TSM will do Taiwan Semiconductor. So this will now return all back the information on these companies. And as you can see, there we go. If we look at the values here, in terms of the size, I mean, Nvidia is a $2 trillion company. Combined all these together, it is almost twice the size of these. So let's have a look at EV to revenue. We want all these metrics to be lower. EV to revenue, it's the highest of all three. EV to EBITDA, it's probably the lowest, second highest after AMD. And PE ratio, lower PE ratio than Intel. I'm actually surprised about that. INTC PE ratio. You would have guessed that would be higher, but I think nope. It's pretty crazy PE ratio. So to be fair, lower than all them. Taiwan Semiconductor with a 25, about the market average. So yeah, pretty hard to estimate. You can see the numbers are all over the place. $300 stock, $500 stock, $1,600 stock. So it looks like AMD and Intel are probably very overvalued compared to what they are. Taiwan Semiconductor, though, I probably will do a video on them. It's a very interesting stock. If you think Nvidia is a bit too high, then maybe you can invest in them, which are the producers of the semiconductors. But you can see pretty all over the place. But currently says it's a buy based on the high PE ratios of AMD and Intel. Next, we'll have a look at the Ben Graham formula for value investing. What this is a way to value companies, and it was what he used for valuating growth stocks. What we look at is the expected growth of the company for the next 7 to 10 years, earnings per share, P base of a non-growth, the AAA bond yield, 4.4, which is the average yield, and the AAA bond yield. So let's have a look and see what the AAA bond yield is at the minute, 4.87. So that's good. We don't have to change it. And Nvidia's next 5 years, they're expecting 33% growth. So we'll have a look at these, 33 and 54. So if Nvidia grow at 33%, not a buy, $400 stock. Ben Graham would not buy it. If they were able to grow at the same rate as they did the last 5 years, which I believe was a 58%, well, we're under 55%, 55%, it would still not be a buy. So all three models, not saying it's a buy, apart from the comparable company PE ratio due to Nvidia and due to AMD and Intel's massive PE ratio. So this is not a buy based on the models, but as I said at the start of the video, I have consistently said based on the models that this isn't a buy, and then the stock went on a 600% run. I mean, Can it go higher? Yes, probably. I mean, it's gone higher when I started this video, but is this company going to be worth more than Microsoft and Apple? I feel like they should be worth more, but, you know, who am I to say? Right, guys, hope you enjoyed the video. Subscribe if you're not already. Check out my Patreon, links are in the description, and I'll catch you guys next time.